Welcome back. Now that we've covered the basics of D&O insurance, let's dive deeper into the key components that make up a director's and officer's liability insurance policy. Understanding these components is critical because they define how and when the policy protects directors, officers, and the company. D&O insurance policies typically consist of three main components: Side A, Side B, and Side C coverage. Each of these plays a distinct role in protecting the individuals and the organization. Let's take a closer look at each one. First, let's talk about Side A coverage. This is the part of the policy that directly protects the individual directors and officers from personal liability. In simple terms, Side A coverage steps in when the company cannot or will not indemnify its executives. Why would this happen? Well, there are times when a company might not be able to indemnify its executives. For instance, if the company is facing financial distress, or if the actions of the director or officer involved were not in line with the company's interests, such as committing fraud or breaching fiduciary duties. In these cases, Side A ensures that the personal assets of directors and officers are protected, covering their legal defense costs, settlements, and judgments. Let's consider an example. Imagine a director is sued personally for a breach of fiduciary duty. If the company is unable to indemnify them, Side A coverage will step in and cover legal costs, settlement amounts, or judgments against the individual. This gives directors and officers peace of mind, knowing they won't be financially ruined due to the legal challenges that come with their roles. Next up is Side B coverage, which is often referred to as company reimbursement coverage. This component protects the company itself by reimbursing it for the indemnification costs when it covers its directors and officers' legal expenses. In other words, when a director or officer faces a lawsuit and the company covers their legal fees or any settlement costs, Side B will reimburse the company for those expenses. This is crucial because defending executives in a lawsuit can be very costly, and without Side B coverage, the company could bear the financial burden of defending its top leadership. Think about this. If a company's board is facing a lawsuit, it might choose to cover the defense costs for its executives to ensure they have the best legal representation. With Side B, the insurance policy will reimburse the company for these costs, allowing the company to focus on its operations without worrying about depleting its financial resources. Finally, we have Side C coverage, which is sometimes referred to as entity coverage. This component protects the company itself against certain types of legal claims, particularly shareholder derivative actions or class action lawsuits. In cases where shareholders sue the company for actions taken by directors or officers, Side C coverage provides protection for the organization, covering defense costs, settlements, or judgments. This is important because it helps the company itself defend against lawsuits that may arise from the actions of its directors and officers, especially in the case of securities-related claims or corporate governance issues. Here's an example. Suppose shareholders file a class action lawsuit claiming the directors and officers misrepresented the company's financial condition. The lawsuit is not targeting individual executives directly, but it does affect the company as a whole. In this case, Side C coverage would protect the company by covering legal expenses related to defending the entity itself. Let's quickly recap the differences between Side A, Side B, and Side C coverage. Side A protects the individual directors and officers when the company cannot or will not indemnify them. Side B reimburses the company when it indemnifies its executives. Side C protects the company itself from lawsuits related to the actions of its directors and officers, such as shareholder class actions. These three sides work together to ensure comprehensive coverage for all involved: directors, officers, and the company. So, as you can see, each of these components of D&O insurance plays a vital role in providing protection to directors, officers, and the company. Having all three in place gives companies the security they need to manage risks and ensures that their leadership is properly protected against potential legal actions. In the next section, we'll discuss why D&O insurance is essential for companies today, especially in light of rising risks and increased scrutiny of corporate leadership. So stay with us. Please like the video and subscribe to the channel.